Hello, this is Kurt Cambier along with Cameron Cambier from Centennial Capital Partners as we do our second quarter 25 wrap up and look forward into the future, what to expect. Been certainly an interesting time period. I think we'd all agree with a change in administration, change in philosophy. Maybe tariffs have been somewhat of an interesting aspect altogether. And also the media, the way the media is reporting things. So the market sold off fairly dramatically in late first quarter. Then it came right back like a V-shaped recovery. And Tom Lee, one of my favorite analysts, says it's the most unloved V-shaped recovery in the history of the country. So that usually means that's a good thing, because generally if the trends are everyone, people tend to be a bit more like sheep, especially in investing. They tend to follow the same trend and they tend to be wrong. So as you all know, and I remain to be very bullish, and I continue to remain very bullish. And I think it's because we have inflection points in this marketplace. We're going to talk a little bit about inflection points and what those situations and things are that are coming. And it really becomes an interesting aspect altogether. So I think it's one of the unique time periods you get as an investor where things begin to change, you seem a bit uncomfortable, but the opportunities are pretty great. One of the first things we want to look at is we're having a lot less regulation, and we're eventually going to have lower interest rates. Regulation is coming down. I know within the last 4 or 5 years, and even before that perhaps, talking to many of my business owner clients, which we have many, they were frustrated at the level of regulations, as we were. The regulations that just come down and came down and came down. If you're a big business, maybe it's not such a big deal, but as a small business, which 85% of the wealth in America is in small businesses, by the way, it really affected the economy, it really affected the cost structure. And as they begin to deregulate, some of that will be very favorable, and some of it for some people may not be as favorable. But it's an aspect where that does loosen up the budgets. And what drives stock prices, you always have to remember, is profits, nothing else. Profits. Profits is what's going to drive stock prices. And so as profits go up, then you have a situation where perhaps stocks could follow. So I think this is going to be an incredible time period and an inflection point in the economy. We're going to go through that. As far as interest rates are too high. They should have been lowered by now. They're about 2 percentage points too high on a statistical basis. And because of the unknown of the tariffs, which quite frankly right now have not had much of an effect on inflation. And I don't really expect them to. If they do, it'll be very, very temporary. It became a point where the Fed is kind of held back and should really be cutting already. I thought they should have probably cut 9-10 months ago, and much more aggressively. They began for a little while, then they stopped. So it's an aspect where when that happens, that's going to be a catalyst in the markets, because markets do like lower interest rates and the economic activity can increase. Always remember, what increases tax revenue is not higher tax rates, because it doesn't. Statistically, it's been proven. What increases higher tax revenue for the government, for any entity, is the velocity of money moving through an economy. So more money moves through the economy as an economy heats up and begins to grow. That creates tax revenues, not increased rates. So it's a very interesting thing, actually, when you begin to look at it. So I have all that statistics, if anybody wants me to share that with them, but probably outside of the scope of this particular video. I think markets have what we refer to as themes, and we have these themes that we have to be aware of. So the first theme is very, very obvious, is artificial intelligence, but there's many stages to artificial intelligence. And I have a lot of clients in the technology sector, and I research a lot on this area. Artificial intelligence is real, it's going to be real big, and it's really early in what's taking place. That doesn't mean it's green lights, sunshine, rainbows, and butterflies every day. There will be some turbulence, there will be some disruptions, there will be some market volatility, market downturns. That's part of the process. But when you have an inflection point and we begin to shift advanced revenues towards artificial intelligence, and the good thing is the United States is the leading country in the world by far, nobody even close, by far in artificial intelligence, that it's going to be incredibly important. So I'm going to go through that a little bit and talk a little bit where those opportunities, what those changes looks like, and what we're looking at. We'll go through a few other themes, and then I'm going to pass it on to Cameron, who has just been doing a spectacular job here in helping our clients. So let's go through that. Artificial intelligence, AI. First wave was chips. chips took off. I can't talk about individual stock names in these particular settings, but there's a lot of really good companies out there, and they've been a bit volatile, but chips really took off. We're bringing a lot of that stuff home because we learned through COVID that we have to have supply chains a bit closer. That's going to actually be a boom for the economy. So chips is the first leg. This year, it's software. Any companies that are involved in software are the companies that are going to do very, very well should do very, very well in the artificial intelligence game. And we have a list of companies that we utilize for that. That'll be big. Cybersecurity, because AI, I don't know anymore what's real and what's not. I remember watching a 60 Minutes program years ago with Tom Cruise playing the guitar, and I thought, my gosh, that guy is so talented. I can't believe it. But it wasn't Tom Cruise, it was a computer. So as artificial intelligence improves, so does cybersecurity have to improve. And I have a relative who was general counsel through the General Dynamics. He retired here not that long ago. And he told me that they get up to 10,000 hack attempts a day as a big military defense contractor. 10,000, can you imagine that? So cybersecurity is going to be really, really huge. And then we get into military defense. We only spend 3 or 4% of our budget on military defense on technology, and those technology companies, you're seeing those stocks really move. Some of those many of you own have done incredibly well. You start to look at things like drones. We're going to spend a lot of money on that. We probably aren't going to be buying the big tanks, the big armored carriers, because the military is just going to change into a technology military, maybe a bit more pinpoint. And those are opportunities. So those are all inflection points in artificial intelligence to where we create real opportunities in an economy. Then you go through the next thing that's coming is autonomous. Autonomous, Jensen Hogg, the head of NVIDIA, said in 3 years from now, if it moves, it's going to be autonomous, which means ain't going to be human being driving necessarily. You have that in drones, of course. You have that in automobiles. You have that now coming in semis. You have that in robotic equipment. One of the things that people talk about is that we can't bring all these jobs home because we don't have the labor supply. That's not accurate. We do have a labor supply, but we're going to turn around and we're going to make it robotics. While the United States has lost manufacturing jobs over the last 20, 30 years, we've increased manufacturing because we became an advanced manufacturing country. A lot of the manufacturing is automated or is robotic, and that's where it's going to continue to go. And that's going to be a huge expansion as we have that opportunity to bring those companies back home. So that's all going to be a really, really big deal altogether. So when you start to look at that, that's kind of the stuff that we look at. And one of the things that ties into both of these, artificial intelligence and autonomous, and I have a lot of clients in the energy industry, oil and gas business throughout the country. And one of the things they say is, you know what, we bring all this artificial intelligence, we don't have the energy to support it. So one of the next things that's going to come is the utility side of this. That's the next leg. It's been chips and it's software, then it's going to go to utilities and energy. And what that is a lot of these big companies, big data center companies, these big producers are actually buying some of these smaller nuclear companies. And those will provide opportunities. It's a little early yet, but those are going to provide opportunities as the demand for energy increases, the demand for inexpensive energy increases. And you're going to see that. And that's why you're seeing a lot of companies relocate their big data centers into places that really probably in a human mind didn't make a lot of sense, like Louisiana or Oklahoma or Wyoming or Texas. They're going there because the energy's there and it's a favorable energy environment. That's going to be a big deal. So the utility side of artificial intelligence is going to be gigantic. It's a little early for that, but that's coming. So those are aspects associated with that. You got robotics and trucks. The next one is housing. When they start cutting interest rates, housing stocks are priced at depression levels. I mean, they're priced so low. Housing supplies are priced so low. When you begin to look at that, we are 15 million homes behind in this country in building, not 5 million, 15 million houses behind in building new houses. We have the largest part of our population is not the baby boomers anymore. It's the baby boomers' babies, better known as millennials. The millennials are in their 30s now. And I have a lot of millennial clients. I have millennial children. And millennial clients are accumulating quite a bit of money and they're buying houses. So we're going to be building a lot of houses. So when you start to think about that, when interest rates start to come down, and by the way, interest rates are about 2 percentage points too high. The Fed is very slow in lowering interest rates. We can have that discussion too. I know why that is. But we can have that outside the sides of this video if you wish to discuss it with me. But when you start to look at that, you're going to see home builder supplies and home builders themselves are really going to have a glorious time period. And they are priced really as inexpensive as I've ever seen it. And we've been on them a little bit early, to be honest. They should have already started cutting interest rates, but because of maybe a change of administration and knowing certain of the tariffs and politics itself, they're a little behind in cutting interest rates, but I do think that's coming. So I think if you look at the aspects associated with it, market trends tend to be the same, but we have some incredible years in front of us with what's happening. The United States, it really could be a Renaissance period, could be one of the most glorious periods in the history of this country, and really the world as the advances take place in things like artificial intelligence and all that kind of stuff can really be a big impact. And not just in the tech companies, that impacts absolutely every single company. So I'm gonna wrap it up here and tell you thank you for the opportunity to work with you. Thank you for your patience. We've had a bit of an interesting year so far, with a big down pull and a big up pull. And honestly, we had very few phone calls from clients who were panicked. And that's really a tribute to the intelligence and maturity of the investors that we work with. And I just want to congratulate you for that. So anyway, Cam will tell you how to contact us at the end of the video, but really appreciate it. Hope you have an absolutely spectacular time period. And I hope you stay healthy and happy, and look forward to talking to you again soon. Take good care.
Hello everybody, Cameron Cambier here. Thank you very much for taking your time out of your day to stick around to my part of the video. I hope I give you guys something good to learn about today. And hey, happy July. It's been hot as heck outside, but I have been getting outside doing some camping. My wife's family came into town, the whole family, so they came from Oklahoma, Arizona, Florida, all came up to Steamboat, which is one of my favorite places. It was a little bit cooler up there. Did some fishing, not a lot of catching, but if you fish just to catch fish, then you're probably not having a good time, at least especially if you're me, because I do a whole lot more fishing than I do catching. But I hope the summer's been a great start for everybody. And hey, we're here, we survived. The market didn't go to heck. We're all still here. The market's still here. Actually, it's hitting new all-time highs as we speak, which if you watched our last video, we're not surprised by this. And I actually, shortly after we filmed that last video, I actually saw a video that Dave Ramsey did. Obviously, most of Dave Ramsey's shows are filmed. And someone called into his show and asked what he thought of the recent market volatility that was taking place several months ago. And he said, look, I think it's a great buying opportunity. And he said something really profound. He said, look, folks, the only people that get hurt on a roller coaster are the ones who jump off in the middle of the ride. And it's almost like he listened to our video as well, because he did talk about how the news really pushes those negative headlines. And he gave another really good one-liner. He said, if it bleeds, it leads, which means if it's negative, it's going to be in the headlines. It's going to be on the front page of the Denver Post. It's going to be the first thing that 9 News or 7 News talks about every morning and evening is the bad stuff. And then if there's some room, they'll talk about the good stuff, even though good things happen all the time. But what I want to talk to you guys about today is really kind of different markets that we can be in, because I think there's a disconnect that people think, we're really only ever in one type of market, which is actually very incorrect. But something I wanted to clear up as well is we often hear clients tell me or my father, you guys are always so optimistic. You're always so bullish. Why is that? Well, in simple terms, history tells you to be optimistic about things. Now, what I have in my hand here, this is not private information. You can go ahead and punch this into your internet browser and find this yourself. It's called The Rewards of Long-Term Investing by Franklin Templeton. I may have brought this up a time or two in videos in the past. I can't really remember off the top of my head right now. But what this talks about is really the landscape and the history of the market. And what this shows is the S&P 500 from 1937 to the end of last year, 2024. It said, though the stock markets return vary tremendously, the average returns for the S&P 500 were positive in 76% of years from 1937 to 2024. We had 21 negative years, which the average negative return was minus 12.5, but we had 67 positive years, which the average positive return was just under 20%, 19.9%. So you take a look at that, the odds tell you that, hey, it pays to be more optimistic than more pessimistic, because the market over time has been more positive than not. And then obviously, if you add in all the averages of those positive and negative years, you get an average annual return of 10.7%, which you oftentimes hear people like me and my father say, well, the market's averaged right around, to give or take, 10% over time. This is where it comes from. And I talked about in the last video how you have to have time in the market instead of timing. So if you flip to the next page, or if you scroll down, if you're looking at this thing on your computer, and you look on the right-hand side where it says a few days can make a difference, you will see that it says $10,000 invested in the S&P 500 index from January 1st of 2005 to December 31st of 2024, end of last year. If you stayed fully invested during that time period, that $10,000 would have grown to $71,750. If you missed the top 10 days, it would have only grown to $32,871. And what it says below here is just spot on, in my opinion. It says pulling money out of stocks in down periods can reduce long-term returns, because when the market bounces back, it can happen suddenly and quickly. Missing even a few trading days could mean missing some of the market's biggest gains. And it goes on to say there were 5,033 trading days during this 20-year period. Yet missing only 10 of them would reduce an investor's final return by 63%. So again, guys, I say it all the time, but it's super crucial in my opinion. Time in the market is more important than timing the market. But what I was alluding to earlier is there's a couple of disconnects that I think people have on the market. I think too many people think that we can only be in one type of market at a time. And that is not true. You actually are going to be in two. And if you've been cheating and not wanting to look at my handsome face, you'll see a couple of things I have written up here. These are the two types of markets that we can be in at any one time. You've got secular markets, which I wrote here are long term. These tend to last anywhere from 10, 15 to 20 years. And generally, it's more on the high side, closer to the 15 to 20 years. And you have cyclical markets. These are short term. These typically last days to months, and occasionally a couple of years. I'll put 1 to 2 years here. So again, secular is long-term, cyclical is short-term, okay? Well, my father and I for the longest time have been saying, and some people believe this secular bull market started in 2011, 12, 13. Well, if that is indeed the case, and they roughly lasted 15 to 20 years, the last one we had lasted close to 20 years, well, that means we have the better part of this decade to run. So more importantly than what's going on in the short term and what kind of market we're in short term, because people either think, oh, well, you're either in a bull market or bear market, that's it. Well, you actually can be in two at one time. You can be a secular bull market, which within that you can have a cyclical bear or a cyclical bull, right? Short term versus long term. And this kind of goes back to the phrase that I like to use, the old Mark Zinder quote. He said, imagine you see a child riding up an escalator playing with a yo-yo. Focus on the escalator and not the yo-yo. So what I did here is I wrote out what a secular bull market looks like. And when you look at that, you say, wow, that looks like a pretty easy ride, which it is if you're focused on the long term. This is the escalator, right? It's a slow process, but it's trending up. It's eventually going to get you to the second floor in the mall or wherever you're going. But when you throw in cyclical markets inside of that, it becomes harder to see, right? Because the cyclicality of markets goes up, goes down. This is the yo-yo. And I'll say it again. When you see a child riding up an escalator, playing with a yo-yo, focus on the escalator, not the yo-yo. Too many people focus on the yo-yo, what's happening more short term. And that's just kind of how we are as humans, right? If like in my car, I drive a 2019 RAV4, Toyota RAV4. And when I get close to needing an oil change, it will pop up on my dash cam and it'll say, hey, maintenance is required soon. So what happens when I usually see that? I usually say, okay, well, it's soon, not immediate. I'm not going to worry about it just yet. However, if I got and turned my car on and there was the oil light on, that my oil was low, you better believe the next place I'm taking my car to is the dealership. But we do that with a lot of things, right? I'm always wondering, what are we going to do for dinner tonight? I'm not worried about what we're going to do for dinner a week from today. So it's human nature to focus on the short term, and this is really what the news likes to focus on as well. Again, what Dave Ramsey said, if it bleeds, it leads, especially if it's negative. We're always so focused on the short term. But when you do that, you time the market, you're not staying invested in the market, and you can get hurt. The news earlier this year was telling people, holy crap, this is going to be a dramatic downturn. It may last for years, depending on where this thing shakes out. And a lot of people bought into that news and got out, and where are we today? We're hitting at all new time highs like market always does. And another reason that we're always so optimistic on things, I've said this before in a past video as well, the US market has a 100% recovery rate. Until it proves differently, I'm always going to be more on the optimistic side of things, because history tells me 76% of the time we're going to be right, because this is how the process works. Now let's go to secular bear markets. I think oftentimes when people hear a bear market, they just think it goes down. But what do bears like to do in the wintertime? They hibernate. So usually what happens after you get out of a secular bull market, or maybe if you're already in a secular bear, which we're not, we think we're probably maybe 8 to 10 years away from that, a little bit more on that in a little bit. Market doesn't crash. It just doesn't really go anywhere. Again, you have a pattern over 10, 15 to 20 years, which is basically flat. The market opens and closes at the same spot. A lot of people remember the lost decade. That was a secular bear market. But again, you still have cyclical patterns within them, right? You got short-term things happen. Sometimes it can move up, but over time, the market essentially opens and closes at the same spot. We don't think we're anywhere close to that yet, and a lot of the reason is for a lot of those things my father highlighted. Artificial intelligence, cybersecurity. I mean, I watch a lot of YouTube. I mean, I am an absolute YouTube fanatic. Years ago, my wife and I canceled cable. Yeah, we still have a Netflix subscription and a Hulu subscription floating out there, but I'm a big YouTube guy, and I watch obviously a lot of investment videos as well, and some really bright minds out there have really kind of opened my eyes to what artificial intelligence could do. And of course, there's no guarantee of this, but you think about some of the things my father already talked about, things being autonomous. Jensen Huang, the CEO of NVIDIA, which I'm not advocating or trying to throw shade at NVIDIA at all. If you want to have a personal conversation on if NVIDIA is a good buy right now, give me a call. I'm not going to make a blanket statement on a video. But when he was in Abu Dhabi several months ago, he said, look, in 3 to 5 years, if it moves, it's going to be autonomous. I mean, we're getting there very, very quickly, a lot quicker than people realize. If you take a look at all the autonomous driving that's already taking place out in Arizona and down in Texas, you know, I always thought of an idea of where kind of artificial and autonomous can be. Let's go back to the example of my RAV4. My RAV4 is just, you know, it's not a hybrid, it's not an electric vehicle, it's just a regular old car. And what is it doing right now while I'm filming this video? It is sitting in our parking lot, getting beat by the sun, essentially rotting, just waiting for me to get off work and drive it back home. I do the same thing the next 3 days of the week. Well, let's think if I had in a couple of years, let's say 3 to 5 years, if I decided, you know what, I do want to get involved in that autonomous driving fiasco that's going to be taking place and taking the world by storm potentially. Well, instead of me driving my car to work and leaving it to rot in the parking lot, I'm going to say, hey, all right, take me to work, but for the next 8 hours, go do Lyft, go do Uber for me, and then pick me up by 5 o'clock so we can go back home. Double income in one day. You think about robotics, where that's coming, and that I do believe that is coming sooner rather than later, folks. There's already a company out there, I can't name names, and plus I believe they're a private company anyway, so it doesn't really matter a whole lot. But for the point of this conversation is there's a robot already replacing janitors. And what it is, it's a little robot that sits in the janitor's closet. It's plugged in, but there's a timer on it. So when everybody leaves for the day, the timer goes off, it stands up, takes its hand, unplugs itself, stands up, walks outside the door, cleans the office, comes back in, plugs itself in, goes to sleep until the next day and does that all over again. And I think maybe a hesitation that people have is just like, oh my gosh, but those robotics are gonna cost so much money. And you're right, at first. You know, an example I like to think of is what's right behind you guys right now is our TV. Remember when really light, thin, high quality, high definition flat screen TVs first came out? They were expensive. They were super expensive. If I went to Best Buy right now and I said, hey, well, how expensive is your top model of TVs. The thinnest, the lightest, the best picture quality. It's going to be several $1,000s. But he's also going to say, well, you know, it's expensive, but last year's model, which is just about as good, is about half or less of the price, right? When Black Friday comes around, that's one of the items. Like, hey, you want last year's really hot TV? Have them for pennies on the dollar. That's what technology does. That's eventually where robotics is going to come. Robotics is going to be huge. Artificial intelligence is going to be huge. Cybersecurity. I also will echo what my father says about home building. Guys, I went to a small Christian school. I had 96 kids in my graduating class. And when you go to a small school like that, everybody knows everybody. I mean, I actually just got back from a camping trip with 12 of my close buddies. Most of them I've known since second grade. We all stay in contact. We still know a lot of our people in our graduating class, and they are looking to either buy homes, or they've recently bought homes, or waiting for rates to come down. That is going to be an absolute boom. And remember, there's 5 million more millennials currently than there are baby boomers. Yes, we do things a little bit differently than the baby booming generation did. We're more about having dogs before we have kids, or having a townhouse before we have a big house. But that wave is coming, and very, very similarly to how the 1990s were when the internet came out. When the internet came out from 95 to the year 2000, the S&P averaged roughly 19.5% per year, roughly doubling its long-term return of, like I said earlier, give or take 10%. And I've talked to people that are involved in artificial intelligence. Some of them are clients, some of them are friends, and I'll kind of give them the same talk, and they'll say, well, I see where you're going with this, Cameron, but you're wrong. And I'll say, well, what do you mean? And they say, no, I don't think you understand. Artificial intelligence is going to be 5 to 10 times bigger as far as the impact goes that the internet had in the late 90s. Well, maybe, of course, that still remains to be seen. But even if it's similar, we're talking roughly doubling the long-term return of the market long-term. So, guys, I think it's going to be a really good time period. My father and I do very much believe we are still firmly planted in a secular bull market, and should be, no guarantee of course, but should be the rest of this decade, maybe even a little bit more. As my father said, you can't have the hangover without the party, and we haven't even partied yet. So for all the reasons mentioned, I think we are extremely bullish. Now, your question may be, okay, well, what tends to happen once a secular bull market is done? Well, what tends to happen, since markets are dynamic systems, you tend to get into a secular bear. And again, doesn't mean the market crashes. Remember, there has been, since the Great Depression, the market has not been down for more than 3 straight years in a row. So you can't tell me that a secular bear market means the market just goes to crap for 10, 15, 20 years. Doesn't really happen. Generally what happens is it hibernates. It opens and closes over the same spot over 10, 15, 20 year period. We'll have to see when we get there. Doesn't mean there's not opportunities out there. It just means investments need to shift. But that's about all I had for you guys today. Remember, think about what kind of a long-term market we're in, and then think about what the short term is going to mean for that. Don't always get caught up in that short term, because when you get caught up in the short term, you're playing around with the yo-yo and not the escalator, and the facts just back it up. When you try to time the market, that's when you get hurt. That's when you jump off the roller coaster. Remember, the only people that get hurt on a roller coaster are the ones who jump off in the middle of the ride. You're gonna have some thrills, you're gonna have some chills, but most of the time you're gonna arrive to your destination unscathed, a little sweaty, a lot of adrenaline going, and been like, man, that was a wild ride, but we made it. Let's do it again, right? I don't really do roller coasters anymore, but that's how I used to be. But guys, the website is kcambier.com. That's KCAMBIER.com. You can call our main office number, which is 303-271-1067. Again, that's 303-271-1067. Talk to myself, talk to my father, talk to Kate or Wendy. You know, our team is always here to help you and clear up anything. And we love doing these videos because number one, it helps us be better at public speaking, but plus it helps you be more educated on how to look at the market and how investing and how you win that game long term. Secular game, not a short-term game. But anyways, guys, thank you very much. Enjoy the rest of your summer. For those of you that play fantasy football, let's start getting our mock drafts together and see that emotional blender we can get put in for football season as well. Let's go Broncos. Let's dethrone the Chiefs this year and get another division title. It's been a long time, but I appreciate it, guys. We'll talk to you soon, and take care.